From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It is Friday, February 12th. This is Tony Fratto. You're listening to the HPS Macrocast. John Fagan and Brendan Walsh are partners at Markets Policy Partners with us. Guys, I have to tell you, as someone who spent a whole career, writing op-eds generally for other people, and it's like the bane of my existence, right? The worst thing is you write an op-ed and you got to get it placed, and it's hard to get it placed. And usually they're group written and it's hard to get the language really good that interests people, And then do people even care that an op-ed is written? Well, Larry Summers writes an op-ed about whether the size of the $1.9 trillion stimulus is big enough, and it creates a firestorm. And so just in terms of, cheering on the yay, work on an op-ed and it has an impact. I'm all for it. But I found myself actually in some
and it wasn't just a Finn tweet firestorm. This one actually made it to the regular news.
Made it to the regular news. It was being passed around the White House. All of it inspired a debate, which I even found myself in the middle of a debate with Jason Furman and Peter Orszag, and Gene Sperling was in there, and Austin Goolsbee, and this sort of the Obama administration economic intelligence all taking different sides on this issue as well. And look, I have to say, I thought it is an important question, we've sort of framed this up a little bit as Summers versus Yellen, but there are people who've jumped in both sides of this. I would say most of the Democratic economic commentators and former officials have jumped onto the Yellen side, that we should go big, and that Larry's concerns, and we'll talk about what Larry's concerns. Maybe I'll frame them up. But while acknowledging them, I guess the consensus from this group, at least, I'm not putting Jason Furman in that group, but the ones who argued for keeping the size at 1.9 trillion, is that the risks are to the risk of doing too little is bigger than the risk of doing too much. We could deal with doing too much, but not with doing too little. Larry's basic argument was, well, look, let's look at the output gap. Let's make our best guesstimate of the output gap. Let's look about what we think we know about the future now. And if we got criticized back in 2009 because you guys measured the output gap and said we did too little, well, by undershooting it by 30 or 40%, what we're doing now is we're not doubling the output gap, we're actually tripling it. And there's a question of what the consequences are of that. One is that, if we have a return of, brisk economic activity later this year after the vaccines, and we also do stimulus, and we do an infrastructure bill, and we do energy spending, boy, that is a lot of, fiscal force in the economy that puts you in the category of sort of World War II levels of fiscal support, and that could have cause inflationary pressures, or it could cause sort of tap out the amount of borrowing space and support for spending for that infrastructure and energy things that he sees as more important for long-term economic growth. So bunch of people took the opposite side. John, where are you on this debate?
I think from where we sit at Markets Policy Partners, we tend to be in the camp of it's better to do too much, and you can calibrate, obviously, and we've talked about this. Mm-hmm. This American Rescue Act, the 1.9 trillion, is an enormous stimulus at a time when the economy is coming out of a very difficult patch. It's hard to argue that big stimulus is not going to be put to good use by some very desperately in need parts of the economy right now. But as we saw with the CARES Act, even in the darkest days of the pandemic, when the vaccine was still, a total unknown, and we were really grappling with a lot of uncertainty, deep uncertainties about the trajectory of this pandemic. The CARES Act, not all that money was spent. And we've talked about this time and time again. You put and certainly the follow-on American Recovery Act, which, as you characterized, Tony, is the sort of second act of this major Biden administration fiscal campaign, is a very long-term spending program. This is not something that is going to be dumped into people's bank accounts on T+2. It's a very different order of magnitude. It's a 4-year infrastructure spending plan. And there are plenty of situations in which you can envision this money, which is allocated, if the economic outcomes are so dramatically fantastic and the economy is, overheating or beginning to show signs of it. Well, that's a problem that, from where we sit right now for a lot of parts of the economy, that's a high class problem to have. It's a problem that policymakers know how to deal with. The Fed knows how to deal with inflation, but they don't know how to deal as well, as we've seen in the case of Japan and Europe, with a long secular stagnation malaise. This was Larry Summers' bailiwick for a long time, was the specter of secular stagnation haunting the U.S. economy. And that is a real problem. It's something that we've dealt with, and maybe this is the real big push we need to change the economy in important ways for the future and invest for the coming decades.
I look at it kind of simply. For my entire career, we've been really crappy about estimating what the output gap is and what full employment is. Mm-hmm. So why are we right this time?
Yeah, well, I get that, right, and that's been some of the arguments that I get, like, measuring the output gap is really, really hard. I used to
really hard, and not to criticize. I mean, it's a
I used to fly around the world with John Taylor, inventor of the Taylor rule, when he was Undersecretary for International Affairs at Treasury, and spent a lot of time talking to him about the output gap, this sort of simple equation of how to think about where the Fed should put the policy rate. And the big unknown in there was, like, your estimate of the output gap, right? Like, you need to have a sense of the output gap in order to make the math work, and that can be subjective isn't the right word. We're in a dynamic environment, and information's imperfect, and predicting the future is hard, and so that's hard. So I get that. I guess my point where I will, I've sort of found myself defending Larry on this is, and you, anyone who's listened to this show knows that I've been, screaming for getting a bill done. We should have had a bill done back in September. And there's no question that this economy needs support. There's no question that certain sectors and certain parts of the working population, households, need substantial support. And so someone who's been screaming about this, and also screaming about the need for big infrastructure investment that we've needed for 2 decades of infrastructure spending. And so I'm the big spender, right? At the same time, back in September, when we were talking about, $2.4 trillion in support, which was the new Pelosi plan back in September, which I supported, there were no economists out there saying we should go bigger than 2.4, right? None, right? Now, we did $1 trillion, $900 billion in December, and now I'm talking about putting another $1.9 trillion on top of that. Well, what's different between September and today? What's different is that we know now, we can see the other side of the river. We've been talking about building this bridge across the river. We know that vaccines are going to be in this, throughout the country in a pretty substantial way by by late spring. The majority of Americans who want a vaccine will have a vaccine, and well before we get to that point, people are going to, the pressure to open up is going to happen much more quickly. So, I went back and looked at there was an op-ed that or a column that Paul Krugman wrote back in November, and Krugman talks a lot about this, that this coming Biden bounce, like this is going to come, like we're going to have a big, bounce back return, and so the focus ought to be on infrastructure, and I think that's real. So, look, I think you can have both, right? I think we should understand that the world has changed a little bit, and we still need large, some stimulus, some COVID support, but I don't think we should be Pollyannish about the potential consequences here. John, to your point, tell me, what's the record of the Fed taming inflation without a recession? When did that?
Well, for the past 10 years, we haven't had an inflation problem. We've had the exact opposite.
It's true.
We've had a lot of difficulty generating inflation.
When there has been inflation and the Fed has tried to tame it, tell me the time that's happened without a recession.
Yeah, it tends to be that tends to be the progression. You're absolutely right. But I think that rolling the tape back, when we look at the Fed is, and Chair Powell made this point too, which is, look, if that is where we end up, we would rather have that than do too little and end up in a malaise situation where we're stuck in the mire and parts of the economy have that permanent scarring, which both Janet Yellen and other members of the Biden administration have talked about, and Fed officials have alluded to it as well. Governor Brainerd, most prominently, perhaps, this risk of permanent damage to the economy. And I think that when we look at the broad scope of the Biden agenda, in reality, he's not going to be able to do very much other than reconciliation and executive action. So when he's got the ability to go big with a bill like this, which is, let's face it, it's going to be popular.
Yep.
And
no question. Yeah.
And his infrastructure bill is going to be popular. There's a political calculus here too, which is, after we do these, we get these 2 bites at the apple on reconciliation here in the first year. And, we've got some executive orders that we can do certain things with and make some progress, but it's going to be really hard to get forward a major legislative agenda, probably through these really narrow straits of the Democratic majorities in both houses. So, and also by going big, there's a signaling effect here too. I mean, when you look at the history of the Democratic Party, there's there's always a timidity, or it's a lot of Democrats criticize their own party for being timid, not having conviction in their own ideas, or having too big a tent in the, covering the party to really be able to internally get consensus on how to go forward. And I think that, this was maybe the George Costanza moment for the Democrats. I'm going to do the opposite of what I always do. I would be, the George Costanza moment where he says, I would be very worried about what Larry Summers was criticizing me for. But you know what? This time I'm gonna order the opposite. I'm going to do the opposite stuff. I'm going to go big. I'm going to go bold, and I'm going to say, that's what the Republicans always do. It seems from the view of the Democrats, they always see the Republicans forging ahead with massive conviction, and while they desperately try to find the middle ground or accommodation or that sort of thing. So I think it's both an expression of his limited policy options over the span of his first term, and a statement of intent of commitment to these ideas.
It'll be interesting to see what this does for for expectations for prices going forward, right? I mean, so we've already seen a bump up. But by the way, look, like I said, I'm for going big. I just think I would have loved to have seen some. To me, since all the news since November has been on the positive side, it would just seem to me that you should adjust smaller, not bigger, from where what your base was at that point in time. That's all.
Yeah,
like,
and this debate's playing out in financial markets as well. We've seen over the last couple of weeks, we've seen this kind of point counterpoint between growth or inflation, and we've seen that play out in for equities more or less, since inflation is low and it's probably going to remain low for equities. This is kind of like a taste great, less filling kind of debate. Like even if inflation is a little bit faster, as long as the Fed is not riding out to be proactive against it, and every indication is that they are not going to do that. That's a perfectly fine story for equities until you get to higher and more painful levels of inflation or a big Fed reaction. But where the debate is really meeting the road here is in Treasury yields, is in the TIPS break evens, which is the market-based gauge of longer run inflation expectations. If you're looking at like the 10-year TIPS break even, and the dollar, and really, if you get a situation in which the U.S. outperforms in its recovery because of the fiscal stimulus, like the consensus had been, there's a huge fiscal flood. The Fed is totally easy. That means that the dollar is going to fall off it's going to continue to fall off the table. We get a very reflationary bounce here. The other possible formulation is the U.S. recovery is so darn good that the U.S. exceptionalism and growth distinguishes itself from the rest of the world. That fuels a counter trend dollar rebound that builds into a stronger greenback recovery over the coming months. And that takes some of the inflationary risk off of it. And you can get a booming economy with the dollar kind of hedging you a little bit on the inflation side. And the markets have whipped back and forth between those kind of narratives over the past couple of weeks.
Do you have faith that and this is what one of the questions, right, is that, because we've heard even not just from Chairman Powell, we've heard it from Rich Clarida, that they are not moving off this policy stance until they see a year's worth of inflation above their 2% target. And the question is, like, do they have credibility on that, right? So it's one thing if it's running in the 2.5% range for a couple of quarters in that year. If it starts breaching 3%, are they still saying those same things? And if you look at Wall Street analysts, they have moved forward their expectations for when the next policy move from the FOMC might be coming, and they have increased their so they've done two things, right? They've increased their expectations for growth in 2021. Some it's going to run hot, right? I mean, from a growth standpoint, which is what we all desire, but they've moved forward their expectations for when the FOMC is most likely to act, and some seeing return to pre-COVID levels of unemployment in 2022, and the Fed acting sooner than we would have guessed 5 or 6 months ago. So that tells me that no matter what Powell and Clarida say, the market is absolutely expecting an earlier move than they are saying.
One thing they do have going for them is the way that we measure inflation, especially housing. So we don't measure your house was worth $100,000, now it's worth $105,000. We measure it on how much you can rent your house. So there's two components. It's actual people that rent houses, and then if you own your house, it's owner's equivalent rent. So because of that, it's also heavily weighted to the large cities, especially New York and San Francisco. We're seeing massive deflation in rental prices. Well, we are seeing massive inflation in housing prices. So because of methodology for the next, and it's also it's an 8-month rolling average, so it's just very sticky.
Yeah.
So for the next 12 to 18 months, it just from a math standpoint, because it's 40% of core CPI and it's about 20% of core PCE. It's just really hard because you're going to have low housing numbers for everything else to make it up, to put it significantly above 2%.
Yeah, and the Fed has a really good argument,
wonky, but it is true.
Yeah, so there's as Brendan says, there's kind of like a dead weight in the center of the in the center of our inflation measurements that anchors it lower than it might otherwise be, and we can talk more about measurement issues. But the Fed has made the case pretty consistently this week. Fed speakers have made the case consistently that near-term volatility and inflation is going to be something that they look through. And that is partially because we're going to have these year-on-year comparators from last year where we had a deflationary shock. And when the economy is just blooming in the spring and summer, hopefully, as we're getting out, there's going to be this kind of rush to make up the difference. There's still probably going to be thin crowds. And so on average, the health charges, people are already talking about some of these increases in prices. It's pretty easy to see how this early rush of post-COVID opening up or wider vaccine distribution opening up is going to be kind of inflationary. So the Fed has a really good argument as to why they will look past that. And when it comes to rates, they're pulling forward their rate hike expectations. But like the Fed is so far out, 2024 is where the Fed is. So pulling it forward brings it into like 2023. And you can see that in Eurodollar futures markets and that sort of stuff. They're inching forward, but it's still like not like next month or next year or even. So where they have less credibility is the taper of quantitative easing. Some it's been a subject of conversation as to whether the Fed might get an earlier start on that. And obviously, as we said last week, Chair Powell has sort of squashed that along with some of the other FOMC members. But, it has been kicked around by, Atlanta Fed President Bostic, and some of the other regional Fed presidents particularly have talked about that. So there's a lot less certitude in the market on, whether the Fed would really hold the line on its 120 billion a month if the economy is roaring in the second half of the year, really. So
yeah, but it does present, because Bostic he wasn't really talking about inflation. He was just kind of being optimistic about the economy, saying, things are actually looking better than we did, that we got the virus, the vaccines, maybe we're going to be open up quicker. And then immediately everyone freaks out about inflation. So like, it's hard to be like optimistic about reopening and not then keep going back in circles and be like, oh, then inflation is going to happen, and then you're going to tighten, and then we're going to a recession.
I agree. Well, hey, look, I'm rooting for the Fed on this, that they can that they do nail it, and that they can both message it and use their tools to get through this. Like I obviously I think I would love to be wrong on all of this, and that they can handle. I just know that it's a pretty complex task that they have ahead of them. If we're going to come back in this next segment and talk about what we think we're seeing on vaccines and how the impact that's going to have on the economy and markets. But there's uncertainty there, a lot of dynamism there that they're going to have to deal with. So why don't we come back and just talk about that piece of it? I want to talk about vaccines when we come back on the Macrocast.
The Sadie Collective's 2021 annual conference will take place on February 19th and 20th, celebrating Dr. Alexander's 100th anniversary of becoming the first African American to earn a PhD in economics. The 2-day virtual event will feature leading Black women across economics, business, tech, healthcare, and policy. Email Sadie Collective at hamiltonps.com or visit sadiecollective.org/SACE 2021 for more information.
We're back on the Macrocast. Guys, we've tried to be optimistic. I mean, I know I'm optimistic about vaccines A couple pieces of news this week were that the Biden administration was able to, announce it was able to acquire another, few 100 million doses, 300 million doses of two different vaccines. Dr. Fauci, came out and said that it's basically by April, anyone who wants a vaccine will have access to a vaccine. It seems like, amazing news, right? We're, if we're in a world where by the spring, by Easter, Trump last year said we're going to get this done by Easter. He didn't say which Easter. It might be by this Easter, right? that we're actually able to start thinking about reopening in a much more aggressive way, and I can see that happening. We're not going to be out of the woods yet, but we're going to be able to see the clear field, from the woods by that point. I just think, boy, this we talked about a little bit in the last segment. This, like, the economy is I think it is going to take off. I think there's a lot of, pent up spending, but we're also going to see rotation in that too, right? That's what we should really expect to see. So that is what I really want to ask you guys about what you're seeing on this. Also, we saw the rotation into the work from home sectors. Are we going to see a reorientation? We saw Disney. Disney reported amazing numbers on Disney Plus, as you would expect. Are we going to see not so good numbers on Disney Plus going forward, or at least not at the same rate? But theme parks are going to get back to making money. They're in theater movies might start making money again. Are we going to see that?
We've seen a pretty sizable rotation when you look at the outperformance of the small cap. It's sort of typified by the small cap Russell 2000, which are the smaller companies that are just more oriented toward U.S. growth, right? They're just more dependent on the U.S. growth outcomes. Those had been outperforming pretty substantially in year to date. And the Nasdaq is supposed to be full of your pandemic winners, which should fall back, but they're almost neck and neck at this point in year to date. So the rotation there's almost like a tide lifting all boats, which is kind of standard with a big liquidity trade. But a lot of the things, as you say, Tony, when it comes to the patterns of spending and experiences, and we talked with this about our friend John Dick on his appearances on this pod, his terrific and insightful appearances on this podcast. Some of these behaviors and pandemic trends are going to extend, and it's not as though you're gonna, as soon as the pandemic opens up, you're gonna cancel all of your Disney subscriptions. I think it's probably it's obviously front loaded a lot of activity, but it doesn't mean that it's going to be abandoned later on. Zoom is a big part, a much bigger part of our lives, and has propelled us forward down the virtual meetings, down the path toward virtual meetings, which are far more productive, I think, than a lot of people feared they would be. So, I think that there's still rotation to be done in the stock market. But clearly, in the current very accommodative liquidity environment, it's not something where that rotation is particularly jarring or negatively impactful to some of the pandemic winners even.
Yeah, I feel like the banking sector is going to play a large role in the economy this year, because you had so many profitable small businesses that just didn't make it through, that are shut. Mm-hmm. But someone's going to take out a loan and start that business back up again because it was a good business, and you go to a bank for that. So I think the amount of loans that are going to be made in the next 12 months is going to be somewhat shocking.
Bigger than
in a great way. Yeah, I think it'll catch people off guard just how much pent up demand, and we have a lot of entrepreneurs here in America, and I think they're going to jump to get right back to opening up.
Well, given what we know about, fiscal stimulus coming and the Fed's policy stance, and where vaccines are. What's the bearish case right now for this economy?
Yeah, the bearish case is sort of the GameStop style. This has just gone on so long, and things have gotten so out of hand in financial markets. They've disconnected so dramatically from fundamentals that the rally kind of collapses under its own weight. And all of this really good news that we've talked about and is so enticing is already more than priced in to financial markets. And so you really can almost only disappoint going forward unless all of your wildest dreams of growth and reflation are realized. And that's not an easy story to tell necessarily when the market is so buoyant, and when a lot of people see it's the constant provision of liquidity by the Fed and so on and so forth. That's not ending anytime soon. And so it's hard for investors to kind of assume that this really is the end of it. But when you look at stock tops and that sort of stuff, there's a lot of discussion about froth, about over exuberance and that sort of thing. It certainly doesn't seem as though the Fed is going to make monetary policy to head some of this stuff off, but the GameStop issue has obviously energized the regulatory bodies around Washington, D.C. And from the perspective of the Fed, they're calibrating their monetary policy for the most damaged parts of the U.S. labor market and the service sector and so forth. And so they don't want to change that. So they would rather have the regulatory apparatus take care of the risks of froth and overshooting. And, it's pretty clear that there's a lot more thought process about that going forward. And so, the reality is it's so hard to target monetary policy. And so you have to deal with some of the reverberations of it in a potentially different way.
Yeah. I think it's going to be. I know, Brendan, you're in Florida now.
Yep.
Yeah, and I thought you were saying that you were out at restaurants. Restaurants are full, indoors and out.
Yeah, so I'm not eating indoor, but when I do pick up from the sushi place, it's full. But we do eat outside, and people wear masks here. There are some people that don't, but for the most part, people behave. But you're allowed to do so much more. And I think people then think that's safe because the governor allows you to do it. So it is very different down here than in D.C.
I don't think we're far behind that, though, to be honest with you. I think we're going to get out of winter. And
yes, I agree.
And I think we're going to see that exact same thing. And I will not be surprised if by, not far into the baseball season, you're going to see people in stands.
Yeah, like everywhere, not just in, Florida. Yep. Well, 30,000 people are going to be at Daytona Raceway,
which is 1/10 of what there is usually there, maybe.
Yeah, I think it's about 120,000 people.
120. Okay.
But so Florida is having about 9,000 cases every day, and they just in the course of the week they have the two largest events that have happened with the Florida. The Super Bowl had 25,000 people, and Daytona is going to have 30,000 people. Victoria just shut down fans and went on a hard lockdown in Australia because there was 17 cases at one hotel. So it just shows how different we're different countries are tackling this thing.
Yeah, I'm told that they. Someone told me this morning that they literally, interrupted the.
The Australian Open.
Australian Open, right?
Yeah.
In the midst of it. So.
And that's one of the arguments that the market is really having about this kind of potential for American exceptionalism during the recovery, which is during the pandemic, the way that Americans behaved with a very obviously maybe higher risk tolerance was really problematic because it would lead to these spikes, which necessitated lockdowns. But if you've got a critical mass, market participants are pondering whether this mindset translates better into the recovery phase in terms of, people are much more willing to get out there in the U.S. And if they were willing at the height of the pandemic without a vaccine to go out without a mask, then, it's maybe the recovery is going to be much faster here.
And especially if the CDC says, come May, it's okay. It's thumbs up. Everybody is going to be back to normal life. I think people are excited to do it.
Yeah, I think some of the other questions, and we're going to get news from the Biden administration on CDC guidance on things like schools also. And, you guys know with kids, what an issue that is for just for working. And there are dynamics in the economy which we know have hit, women more than men as well, who, have largely made the decision to stay home with kids more than men have. So the definitely big economic issues that this outcome will, whether it's the vaccines or some of these policies on things like whether back to school is safe. I think they're going to have economic impacts.
Yeah, I know that the DC parents of public school students, if our kids aren't in the fourth quarter, I think you're going to see riots in the streets.
Yeah.
My kids may never learn to add. They may never.
Hey, let's take a break and we'll come back with our last segment. You're listening to the HPS Macrocast.
Markets Policy Partners provides sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com or visit them on Twitter @marketspolicy.
All right, we're back on the Macrocast. Guys, I haven't looked this morning. Last I saw it was like 47,000 on Bitcoin. What is Bitcoin?
It's the flagship cryptocurrency. It's it's.
But we have to stop calling it a currency. But look, I mean, HPS client BNY Mellon announced that they're going to be, they're doing transactions in Bitcoin now. It's big business for a lot of financial institutions and central banks and others now, or it aims to be at least. Is it a currency?
Well, I don't know if it's a currency, but it's an asset class. One of the things that
I would say that.
So a currency has to have all of these different, the sort of three characteristics of the currency, and one of the things that Bitcoin doesn't necessarily have is it's not a particularly good medium of exchange right now, because everybody and their brother that owns Bitcoin is bullish on Bitcoin. We had Mike Novogratz, who's one of the leading lights of this. He's an ex-macro guy who's reinvented himself as a crypto guru up in New York, was talking about $100,000 for a Bitcoin. Now that's probably aggressive, but maybe not that aggressive in terms of the mindset of the community that really is into this into crypto. And so the idea that this is going mainstream and is an asset class, it's a highly speculative asset class. It doesn't seem to be driven necessarily by the same kind of traditional macro dynamics that drive, say, gold, which is, some people had called Bitcoin digital gold because of the scarcity factor and because it is used to, as a purportedly as a hedge to inflation, a hedge to irresponsible governance and that sort of stuff. But it doesn't necessarily seem to follow that logic as an asset. It seems to have its own sort of speculative dynamic. But this going mainstream has really supported it. And it was earlier this week, the Tesla disclosure that they'd purchased an enormous amount of Bitcoin gave it another shot in the arm here and more institutional legitimacy, the Elon Musk magic.
Yeah. And they're going to accept it as payments for a Tesla.
But why would you buy a wasting asset like a Tesla? As great a Tesla car is, whatever, that's still a car. It's a wasting asset the second you drive it off the lot. And you'd buy it with a currency that you think is going to be tripling, or that could go up by a factor of 10.
Yeah, this is always, I know this has always been like sort of my, not criticism, just observation. We don't know. Maybe there's a limit on how much gold we can mine, but we don't actually know, right? Like there may be for all intents and purpose, endless amount of gold in the seams of this planet, that we've only scraped the surface of. We know, in fact, that there is a limited supply of Bitcoin.
We're coming to the end, too.
And we're coming to the end.
And so Bitcoin has the same carbon footprint as the country of New Zealand. So it is also an environmental disaster.
It is it's absolutely an environmental disaster. And so look, we are inventing some uses for it, right? There are some some uses for it, but it may as well be for most people. Bitcoin is like, having a Monet, right? It's like,
well, yes and no. So I'll tell you why.
If you have a Monet, do you spend it? To John's point,
but it's tax avoidance. So that's why you buy a Tesla with your Bitcoin. As it goes up, it's just stuck, and you can't use it. So you can use a little bit of it and not pay taxes on that massive capital gains, and you get a Tesla out of it. So that's why you use it.
You take a fraction of your
because
Bitcoin.
The government wouldn't be able to know that you spent it with Bitcoin.
Well, if you buy something big like a Tesla, they do know, actually.
Well,
I suppose Tesla has to disclose it, right?
Yeah. The other thing about Bitcoin is, the current valuation. To what extent does the current valuation price in what's going to happen to Bitcoin in the regulatory sphere? I don't know if we would all agree, but I certainly think that there is more regulation to come on Bitcoin. We haven't gotten even to the foothills of how crypto will actually be regulated going forward. And what does the price of Bitcoin look like once it's very clear that it is going to be wrapped into this, know your customer, anti-money laundering, all of that is coming soon to a theater near you, Bitcoin, and it may be a big game changer, maybe not, but I think it's hard to argue that we know what Bitcoin and crypto will look like after the regulators have really had their say.
Yeah, I agree. To Brendan's point, right? I mean, there are two things that you can't get around, and one is that Treasury wants to know two things. One is, are you paying your taxes on it? Not just Treasury. To your point, like if you're buying that Tesla in California, you have to pay California state sales tax also, right? So it's like kind of hard to hide this stuff. But paying your taxes, and Treasury wants to know that you are neither accepting money from the bad guys or sending money to the bad guys. So if Bitcoin doesn't account for those two needs of government, those aren't desires, those are needs. If you can't account for that, then it's hard to see what the long-term future and viability of any of the cryptocurrencies are, except for central bank created.
I was just going to ask you that.
Yeah.
I know the Treasury is starting to look at central bank digital currencies.
Yeah.
But it's very early innings. Do you have a sense of how this was going to play out?
They're looking at it, right? And so's the ECB is as well, and other central banks are. Of course, no one. Here's the scary part, especially for, I think for anybody, but especially for libertarians, is look what the Chinese are doing. So the Chinese have a fairly large pilot program with a digital currency that allows them to see every transaction that right. It's like that's the thing that the crypto crowd wants, which is to be able to hide from government.
Yeah, they gave us the technology to do the exact opposite.
Yeah, again, this is it's incredibly short-sighted by the Chinese, of course, right? And that they are cursed by myopic vision on some things. Like they do not see how this damages and reinforces the reputation of the Chinese in the world to do this kind of thing. So if they think that they're creating an asset that is going to somehow destabilize the dollar and the global economy, like they're bonkers, because no one wants to be sharing information with the regime in Beijing if that's in fact what they're doing. And it does appear to be what they're doing.
Yeah. Well, you look at Ant Financial. They turned it into a government regulated financial institution.
Yeah. Well, I think we'll be talking about this for a while. But the price of this asset is astronomical. I still don't see. I get it if you want to ride this wave. John, you mentioned the characteristics of a currency as a unit of account, a medium of exchange, and a store of value. Seems to be it's been pretty good as a store of value. Not so much as a unit of account, and certainly not a medium of exchange. Right. And
no, that's going up. So PayPal just had their investor meeting yesterday, and in it they say that they're going to make paying with Bitcoin much easier.
The question is, how much can you do because you are spending a not a depreciating asset, which is the thing we understand with money.
Yeah.
What part of the velocity of money is understanding that it is depreciating by a little bit, every day. And so don't hold on too much into it, put it into an investment or spend it. When you have a rapidly accreting asset, your instinct is to hoard it.
Yeah.
Right.
Yeah.
So,
the guy who bought a pizza way back when with like 8 Bitcoin.
Yeah.
Yeah. No, it's back. Yeah.
Those were the days.
Yeah, no, I remember. It was 2012.
I don't remember how many Bitcoin it was, but
but I was in San Francisco on a payments tour in 2012, and everyone was excited because Bitcoin had popped to like $550. That was less than 10 years ago.
That's like it's just obviously just blown past that. So we all wish we had a couple, hidden away somewhere.
But we would have forgot our passwords
for
anyway.
Sure, I would have. No doubt. All right, guys, great show this week. Have a great. Don't forget it's Valentine's Day this weekend. So make sure you take care of your business.
Love is in the air.
We will talk to you next week. Have a great weekend.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.